Amid escalating regulatory demands and a surge in fraud, the need for financial institutions to remain compliant, efficient, and informed is paramount. What's getting in the way? Manual processes, lack of insight to regulatory changes, lack of transparency for decision making? With Thomson Reuters Risk and Fraud Solutions, financial institutions achieve more than 40% more efficient customer onboarding, making their teams even faster at reducing risk to fraudulent losses at the same time. Our risk and fraud solutions empower financial institutions to safely onboard and continuously evaluate customers, members, and vendors, and increase new business securely through automated technology. We equip institutions to navigate complexities with confidence by elevating beyond mere risk management, setting new industry standards for decision making and operational efficiency. Visit tr.com/clear to learn more. Hi, I'm Sarah Beth Felix, and welcome to FinCrime Unfiltered. This is the first podcast of hopefully many to come. My background, as some of you may know, has been focused on the world of anti-financial crime, covering money laundering, fraud, and sanctions. I'm truly thankful for this platform, and I hope that it brings something different to your everyday work life. So, a little background on this. This podcast was actually a long time in the making. Back in 2019, I started recording a show I never published. And what happened was it ended up documenting some interesting topics and trends at the time. And while no one has ever seen them, and I hope nobody ever will see them, I've gone back and I've looked at some of the trends that I was talking about and expressing frustration and wonderment over. And we're still seeing several of those things 6 years later. So I will be resurrecting some of those old topics, putting a new spin on them, maybe updating some, maybe with more frustration throughout the course of this new podcast. There will also be some crossover from what I post on LinkedIn with what we talk about on this podcast, as both platforms serve an important role. Overall, my informal disclaimer here is that while I may seem a little salty, I think I am for the most part, we do need to be able to call things out in our industry that aren't right or that don't fit the way that it should. And I know I've met a lot of people over the years of speaking at different events. And a lot of times people come up to me and they say, "Thank you so much for posting that. I can't say that publicly. But when I read your post or when I read your comments or when I heard you speak, I felt seen in my job." And so that's really something that I hope this podcast really provides an opportunity for everyone to feel like they're being seen in their role, even though their job may restrict them from posting their opinions or questions or disagreement with things. So I really hope that this time together will encourage those that may be stuck, maybe give some new ideas to those that may need it, and really get us all thinking about how we can actually make a difference in our industry. I feel like most of us have been running standing still the last few decades, really, with no real measurable improvement in regulatory changes. There's really been no decline in dirty money or safer communities. So while that burden doesn't necessarily fully fall on those in the anti-financial crime world, I truly believe that we play a big role. If we want to reduce greatly the number of humans trafficked or whatever the worst crime you can think of, we have to cut off the head of the snake. And that head of the snake is the money supply. So with that, first podcast in the books. I would like to stir the pot a little bit. If you follow anything of what I write, I do like little pot stirring every now and then. So why not start off this new part of my career stirring the pot? So here we go. Let's talk about some of the changes. There's been a lot of changes since the new administration. And I'd like to just talk about some of the things that we're seeing may or may not be tied directly to the priorities of what the new administration is looking at, but I think they're definitely changes that have an impact in our day to day life. So, first off, we've seen a trend in how the Office of the Comptroller of the Currency, the OCC, and the FRB, the Federal Reserve Board, we've seen different public comments that their leaders have made, as well as some advisories and guidance that they have published. And while I'm all for regulatory agencies talking putting forward what their priorities are, there's been a few times where I'm like, this doesn't feel right. And one of those was about how the Federal Reserve Board, um, in public comments made, as well as the arrangement of certain individuals in certain positions there, they generally have an overall view that community institutions are inherently less risky than larger financial institutions. And that then leads us down the road of discussing why little institutions or smaller asset size institutions have to do all the things that the big institutions do. And of course, those comments aren't always 100% directed at the AML function, but typically the first one on the chopping block has to do with the AML and CIP or Patriot Act type of requirements. And sure enough, in public comments, that comment came out saying community institutions are inherently less risky than larger FIs, and we should evaluate all of the regulations that smaller institutions have to comply with. And I do agree with that at a 30,000-foot level. We should absolutely be doing that. But then the first one that they suggest that needs to be cut or trimmed down has to do with our world. And that to me is a dangerous start. Not a good look if we're trying to make our country safer, which is the priority of this administration, is to make the country safer. That is like what they've come out with. We can't expect to do that if we are just broad brushing all smaller institutions are inherently less risky than larger institutions. I think we need to take a beat on that. The other one came from the OCC, in which they said that they will not be evaluating reputational risk. And I do appreciate that. I do understand some of the background that they were talking about, how uh, and banks under the OCC were informally told to not bank certain businesses or provide financial services to certain businesses because of the reputation risk attached to them. And while I agree that that needs to go, um, I believe that there are reputational risks inherently woven through banking any business and any person that could be attached to dirty money or illicit activities. So if we just, with one big claw, remove reputational risk as a whole without considering any of the other implications that reputational risk helps to mitigate, that eye on having a good, sound reputational risk management program, it doesn't just have a benefit for those businesses that were de-risked before because they had a higher risk reputation. It also has a negative effect on the other side, where banks really no longer care whether or not, for the most part, unless the regulators find out what the reputation of that business is. I hope that made sense. So I feel like there's kind of I don't know if you've ever played one of those claw games where, you waste a whole bunch of money, your kid wants to play, you put $5 in the machine, you got that big claw that comes out and it goes down, it tries to grab that animal. That's what I feel like we're doing with at least some of the things that we've heard coming out over the last several weeks. The second big change, and this is talked about a lot. I know this was on the newswire nonstop for weeks on end, was the CTA rollback. So the rollback of it does not change the 2018 beneficial ownership or customer due diligence requirements at all. If anything, if it affects an AML officer in any way, it affects them because now we have no idea who the beneficial owners are of these companies. The US has the largest onshore offshore states, that's what I call them, onshore offshore states that provide corporate secrecy, veil of anonymity. And the CTA was really to give us a peek behind that veil of secrecy. Now, while banks and credit unions and securities firms were not going to be the direct consumers of that information under the CTA that businesses were going to give FinCEN, we did have a way in which we could ping the beneficial ownership information database and get the information that that business had told FinCEN, who their owners were. Hummingbird is a compliance platform that's reimagining what's possible from financial crime investigations. Teams using Hummingbird work more efficiently and effectively without compromising on quality. Investigators quickly get to the heart of each case with information at their fingertips and compliance grade automation and AI to boost productivity. Designed for essential work in anti money laundering, anti fraud, customer due diligence, and more, Hummingbird allows you to customize the platform to your policies, giving you exactly what you need to get the job done. Hummingbird is determined to fight financial crime by empowering those on the front lines, because financial crime never stops evolving, and neither should the tools you use to stop it. Learn more at hummingbird.co. That's hummingbird.co. To me, the biggest negative effect of this is that we no longer have a view behind that. Now we just have a brick wall. We have no way to know who the owners of several businesses, of thousands, probably hundreds of thousands of businesses are in the United States. And when we put that next to the priorities of the administration, which is to find and stop the FTOs and the SDGTs, it makes it very difficult to say, oh, yes, you do actually want to go after these FTOs and these SDGTs, cartels essentially, but you're also gutting the very thing that would let us know who is behind those companies, right? Because if if we can't see who created those companies, who the control person is, who the ultimate owner is, then how will we know if they are related to a sanctioned person or to an FTO or a cartel? We can't. We know that secretaries of state sites, many of them, still allow individuals from foreign states to set up businesses remotely. That's fine. But we know that we have foreign enemy states that are sanctioned. We have sanctioned countries that can access various Secretary of State sites. I've done it. I've tested a whole bunch. I will not put any of those states on blast. But several states need to shore up who they allow to access their corporate uh, corporate establishment site, because what we're seeing. And again, it's going to be hard to prove this because now we don't have the CTA. So now we have no businesses having to give their information. So since the CTA is only for foreign businesses, we have someone from a state or from a country that is an enemy or a sanctioned country. They don't even have to get a VPN service in order to ping their server from, a benign country. They can just use the server that's in their country, hop on to the create a business here in this XYZ state, and they don't have to give who the owners are. So a foreign business who would have been subjected to the new CTA no longer has to be subjected to the new CTA, because all they have to do is log on remotely to several Secretary of State sites that allow them to set up a business remotely, and they can get they're a registered agent who we know we have registered agent farms all over the US in various states. They just find someone who's a registered agent in that state to be their person who's physically in that state, and then they become the representative of that business. And boom, they're no longer a foreign business. Now they're a US business, and now they don't have to give any information to FinCEN about the owners of the business. I know it's very complex. I tried to make it more simple, but I think I made it a little bit more complex on accident. But if you have any questions about that, please post it, or find me on LinkedIn, because it is very, very interesting when you start looking at the I guess the beauty and the curse of a true constitutional republic, right? Where we do have limitations on federal law. We can't force a state to do something. But in this case, if it's the will of the federal government to protect, to identify FTOs and SDGTs and how they're running their money, The only way we can do that effectively is by knowing who is behind all of these businesses. We can't we cannot gut the very thing that gives us a peek behind that veil of secrecy. So while that kind of gave me a little bit of a moment where I go, that doesn't that doesn't seem to be right. One of the things I do want to remind people of, and if there's any government folks listening to this, please. Um, the last time an FTO or an SDGT, the last time they created a business, they would not actually create it in the name of their cartel, right? It's not Cartel de Sinaloa, Inc. That's not how they start businesses. So this is where I mean when we talk about FTOs and SDGTs and having to get behind who the true owners are, it's because we know that all the FTOs and the SDGTs that are listed, they make their money, they run their money, they keep their money in front and shell companies. And so when we allow states to act as a safe harbor, if you will, for businesses in an anonymous way, it really doesn't. It really does not move that needle in terms of trying our best to cut off the head of that snake, and that snake being all the FTOs and the SDGTs that are listed. So, just something to think about. So, when we look at that, um, we have to know that your institution has to really be on guard for some of the typologies that we know are particular to the FTOs and SDGTs. I do have a listing. I'm not going to say it on on this podcast, but I do have a short listing of the way in which the money is made, moved, stored by cartel. And this is all public data, right? This is all other research that has been done, but I tried to make a list of it because I think it's good for AML analysts, especially, to start thinking in that way. FinCrime Unfiltered is proudly supported by Hummingbird. Hummingbird is a modern compliance platform designed to make financial crime investigations smarter, faster, and more effective. Because today's financial criminals are sophisticated, savvy, and agile, meaning the tools used to fight them should be too. Learn more at hummingbird.co. Thomson Reuters Risk and Fraud Solutions empower financial institutions to safely onboard and continuously evaluate customers, members, and vendors, and increase new business securely through automated technology. Visit tr.com/clear to learn more. Moving on, another area that we really need to talk about impacts, I would say, not only the day to day of AML officers and their teams, but also the effectiveness of the priorities of this administration in regards to the reporting thresholds. So, before we go down this path, um, I think we can all agree that our AML regulatory framework needs an overhaul. Um, there's like there's a lot of work to be done. But I think there's 3 quick things that come to mind when I think if we were to change anything, the thresholds would not be the first thing I'd think of. So just some quick things off the top of my head that I think we should deal with before we start arbitrarily raising reporting thresholds. So how about let's close the gap that allows trillions of dollars a year in unregulated payment rails in the United States. That would be the first thing. And I constantly write and post about this. And if you're confused by that statement, please reach out to me because I've got a ton of examples. The second one for me would be let's update the 1980s MSB laws that allow really a fractured way in which we apply know your customer or record keeping thresholds to certain money movement based on the dollar amount and or the function of the underlying method. It doesn't make sense, and it's not how any of our peer nations write their laws. The third one for me, if I were to change anything before changing the thresholds, would be how about we shore up the uneven examination standards across community institutions from banks to credit unions? It's not right that we have community banks that are held to a higher standard that their credit union counterparts that are typically in the same town are also not held to. We all have the same FFIEC exam manual. all institutions should be held to the same standard. Now, I will note um, this week, there was some mention of regulatory agencies doing away with the exam teams that are segregated by the by the financial institution size or complexity. And I really do applaud that potential move. If, if, asterisk, all the examiners are instructed on how to test for effectiveness. If we take a uh, if we take an examiner that's used to a more simple, structuring, focused community bank AML program and stick them in a tier one, super complex, where they have teams of data scientists and specialists that are looking for terrorism, that small bank examiner may not ask the right questions. Vice versa, if we take a big bank uh, examiner that's used to dealing with data scientists and used to dealing with teams of former federal law enforcement agents and stick them in a community institution in which the AML officer, typically a woman, is wearing 8 hats, they probably won't ask the right questions either. So I think it's important that we kind of wipe the slate clean and we get down to how do we test for effectiveness. I call them indicators of effectiveness. Does it mean that something is ineffective or effective? No, it means that there are indicators of ineffectiveness or indicators of effectiveness, and it's the start of a process. And they are applicable no matter how big or small or complex or simple financial institutions' programs are. So I would really hope that we would focus on those things. Of course, that's just 3 quick things that come to mind. But let's talk about some of those threshold rumors because that seems to be the thing that everyone is wanting to change. The last time I heard CTRs being raised to 5x the limit. So 50,000. The other day I heard 70,000. Someone then said, well, let's just do away with it altogether. What? Then we have SARS having a 15x threshold, I think was the last time I heard, or possibly even higher. And what really stood out to me is that the people throwing around these new thresholds have really never worked a day in the life of an AML analyst. They've never written a high risk customer review. They've never dispositioned an alert. They've never, followed that trail of money to see if it's reasonable. And everyone keeps talking about inflation. They keep saying inflation is the reason why we need to raise these thresholds. But to me, that's the wrong basis to make any type of adjustment. The basis needs to be what is reasonable? Is it reasonable that somebody would have more than $10,000 in cash on them? Most times, no. I mean, I keep 100, 100, 150, maybe 200 bucks on me at a time, but that's because my babysitter still likes to be paid in cash and not Cash App. But if it wasn't for her, I probably would not have that much cash on me. I think it's still unreasonable that most people would have $10,000 in cash on them, regardless of inflation. So there's one other aspect to this, and I know this will probably ruffle some feathers, but one of the themes I've seen continuously throughout my time working with lawmakers in DC, as well as sitting with board members of different types of institutions, there's a massive chasm between the lawmaker and the executor of that law. Similarly, I've worked with various federal law enforcement agencies and agents over my career, both in the US and internationally. And again, I've worked with lawmakers in the DC area. There's also a massive chasm between those two. Very, very similar. And I believe this is the perfect example where we're seeing more now than ever before the rumor swirling about the raising of the thresholds. We have producers of the SARs and the CTRs who truly do not have an advocate in DC because most lobbying agencies are taking what the CEO or the chief risk officer is saying, but not what the AML officer is saying. And they're taking that information to DC to feed to lawmakers. So we have the producers of the SARs and the CTRs that really have no say in these thresholds. And then the end users of the SARs and the CTRs, which is federal law enforcement, they are also not included in this process. And then we expect these thresholds to be sound and effective. I do not see that outcome when we do not have either either the producers or the consumers of the SARs and the CTRs in the conversation. So, raising reporting thresholds for CTRs and SARs, gutting the CTA, pulling back on reputational risk, not defining what reputational risk is while simultaneously lowering the threshold for cash on the border region to $200 for certain MSBs. It's a lot, but it doesn't make sense. I think as a highly logical person, I like I like when things come into my brain and I go, "Oh yes, that makes sense. I'm gonna stash that here." None of what I'm seeing is making sense when my baseline for everything is this administration wants to take care of some of their national security risks that they ran on. Um, FTOs and SDGTs we constantly see in the news, yet all of the things we're doing are really gutting that. So we have really two questions. I think one of the ones is, where do we go from here? I know I've said a lot. I probably haven't been super positive on everything, but while we wait to see what changes, what doesn't change, I guess who gets into trouble and why, I would encourage you focus on the national priorities. FinCEN has started to tie their advisories and guidance to the national priorities, and I'm so happy to see that. But it also tells me that these priorities are not going away. So we know the current administration is focused on a few of them. We know that they are focused on the TCOs. We know they're focused on the DTOs and human trafficking because those are all noted by those FTOs and SDGT designations. So while we wait with great expectation on further advisories from FinCEN regarding some of the suspected underlying activities that underpin these priorities, really in the meantime we can and should start looking at a few things. So for smaller institutions, how many SARs has your institution filed for human trafficking or drug trafficking? Let's say in the last 6 months. Is it zero? If it's zero, that's a good sign that your institution is most likely missing activity that is tied to the national priorities. And I know that there will be a lot of reg a lot of reg tech providers, some consultants, and maybe some smaller bank CEOs that would contest my statement. But if we start at the position that you are a small bank, therefore you don't have human trafficking, or you are a small bank, therefore you don't have drug trafficking in your bank, if that's where we start, then you will absolutely be missing it. 100%. The smallest bank I've ever been in was under 20 million in assets in the middle of the Midwest. It was an hour and a half drive to the closest regional airport, and they had both human trafficking and drug trafficking in that bank, and that was 12 years ago. So I would not make the assumption that human trafficking and drug trafficking are not in your institution unless you've done the work to really actually say, look, we ran all these analytics, not our AML system hasn't detected it yet. That's not the answer. We've run all these analytics, all these different typologies. So just to those who may get their feathers ruffled by my statement that even small institutions can have illicit activity running through them. So, for more sophisticated financial institutions that have refined teams of specialists going after complex typologies, what does it look like when you would take recent drug or human trafficking SARs that you may have filed and you start to look at them through the lens of what an FTO or an SDGT may look like within those SARs? And I think that's a different investigatory process. So the question is, could a recently filed SAR be linked to a cartel, but the investigatory process or analyst may not have been looking with that mindset. So I think that may be a good, decent exercise to test while we wait for some other things to come out. So, and then something to ruminate on as we close. How will we, as AML officers, practitioners, analysts, how will we effectively execute the priorities of this administration while decision makers are gutting the very tools, networks, and reporting that we need to find these FTOs and SDGTs? And that's not something necessarily I think that needs a formal answer, but I think it's something that we really have to wrestle with. I certainly don't have all of the answers. My suggestions just a few minutes ago are really kind of a starting point. So I would love to hear from you. Thank you for your time today on our first episode of FinCrime Unfiltered. Please leave comments or suggestions below, where you can find me on LinkedIn at I Follow Dirty Money. Thank you for your time, and we'll catch you on the next one.